No problem.
All right, so hello and thank you for joining us today, everybody. My name is Brad Wydra, or TouringNews, so I'm one of the people that you might see up on the tweet right there, and I'm joined today by Tumisho Ramodisa, I believe, a 19-year-old young, budding macro analyst, just kind of curious mind, coming from Johannesburg, South Africa. The way that Tumisho and I met, it was just kind of like a happenstance meeting yesterday. Peter Schiff put a tweet out, and a little bit of our conversation today, if anybody is tuning into this podcast, it's going to be about macroeconomics, Eurodollars, what are Eurodollars, why the Evergrande banking crisis could have international contagion events. Is it more Bear Stearns? Is it more Lehman Brothers? And it's kind of just be like a back and forth idea bouncing between two people who look into the macro space from outside of the macro space. I know Tumisho said that he does manage a small equities portfolio for himself. I maybe have like $500 or $1,000 worth of investments, so I wouldn't say that we're anybody big within the macro or the hedge fund world, but we've taken a liking to kind of like staring into the global matrix, would be one way to call it. So, yeah, Peter Schiff said today's dollar rally makes no sense. The fact that the dollar is losing purchasing power much faster than expected doesn't make the dollar more valuable. Yet traders are buying dollars because they naively expect the Fed to tighten policy to fight inflation. That's a losing bet. So this was tweeted November 10th, 2021 at 3:17 p.m. And I tweeted back, wrong. During write-downs of debt and scrambles for liquidity, the global reserve currency will rise against a basket of international and emerging currencies as everyone rushes to get United States dollars to pay whatever Eurodollar, yet dollar-denominated debt they are being squeezed on, to which you replied, very few understand Eurodollars and shadow money. That's why they'll always be wrong about the dollar crashing. So I think that that's kind of like a good introduction to who I am and who Tumisho is. And I'm going to give the microphone over to Tumisho. Do you want to take a little of these tweets and maybe set the stage and begin us down our path today?
Yeah. Well, first of all, thanks for introducing me to your show. It's a pleasure to be here. So, yeah, as you said, I'm Tumisho. I'm from Johannesburg, South Africa, and I'm a macro person. So I like digging into the macro stuff, and I'm a day trader as well. So, yeah. So with Peter Schiff's tweet, I found it interesting when he said that this dollar rally does not make sense, which is kind of weird because he mentions the dollar rally doesn't make sense because inflation came hotter than expected. However, when you think about it like that, does consumer prices itself have anything to do with the DXY? For starters, does consumer prices have anything to do with the DXY? Because the dollar against a basket of other currencies around the world is a function of what the global dollar system is doing. So if we think about it, this is Eurodollars. So Eurodollars, if for those who don't know what Eurodollars are, this is offshore money. So I think I should explain what it is and how it functions, because Eurodollars is basically offshore money that the private system or the private sector creates in the form, we can call it banks, right? So banks have balance sheets with each other, and it's all just balance sheet mechanics. It's all the bookkeeper's pen, as Milton Friedman always says. So they're basically creating Eurodollars or dollars, which are foreign dollars. They're basically creating foreign dollars out of thin air
Quick
in the shadow.
question, a little counter to this. When they quote create Eurodollars, quote, let's say that I'm in Poland on the currency of the zloty, and I'm being told that my debt needs to be repaid in dollars. My clarifying question that I want to ask to you, and maybe one that I've never even had defined before, does the Polish bank actually lend out in dollars, or do they lend out in zloty and require dollar payment back?
Well, it depends. It depends on the circumstances. So let's just clarify this. So if the Polish bank has dollars, right? Because I think all countries around the world, or most corporations around the world have either dollars or they have dollar assets, which could be in the form of US treasuries. So what they could do is, if they need dollars, right, they could either sell treasuries, and you can see that with the information from the BIS, Bank of International Settlements. So what happens is they could either sell those treasuries for dollars or whatever dollar denominated asset they have in order to, let's say, settle this transaction. I hope I'm getting it correctly. Or maybe I haven't understood your question
Yeah, I'll
properly.
I'll try the question again.
Yeah.
I'm a business in Poland, and I am going to end up with one of these EuroDollar loans. So I agree with you that EuroDollars are dollars that are either created or required to be paid outside of the United States banking system. So I think that my main question is the Polish bank going to give me dollars and then require dollars paid back? Or are they giving me zloty, the Polish currency, and then it's on me at the end of the terms of that debt to pay it back in dollars? And the reason that I'm trying to ask this question is because if they're giving out dollars and it has to be repaid in dollars, there's still not going to be enough because debts are always going to accrue faster than they can be repaid. However, if they're not creating dollars and they're requiring dollar back payment, that would even be a tighter squeeze and a tighter crunch.
Yeah, and exactly. So it'll depend, as I said. So if a Polish bank creates dollars or euro dollars and gives you a loan, right? Because when they give you a loan, they basically creating money out of thin air. So they create these dollars out of thin air. And then so your question is, what do you as the borrower, what do you pay it back with? So
No,
most of
no,
the times
no. It
you
was more of what I'm loaned. I'm more
yes,
interested in what I was loaned. If I'm loaned dollars or if I'm loans, I understand that it has to be paid back in dollars. But my
yeah.
question is the original business loan that I take out, do I get dollars or do I get zloty?
Yeah, well, you get dollars. You get
Right.
dollars
Okay.
because for some reason you probably have a reason why you want to get a loan in the first place. So let's say you need to, because I think it's kind of different, because if you're just a customer it's a different story, but if you're a business, right? If you're a business and you're getting a loan from a Polish bank, a dollar denominated loan, you obviously need those dollars for, let's say, to buy oil. Let's say you're a transport company, so you need to buy oil or you need to buy gas or something like that. So a lot of things are priced in dollars. That's how the global system works. So you need those dollars. So most of the times you'll obviously be given that loan in dollars, and then you'll be required to pay in dollars.
Okay.
Yeah, I hope that answers the
Yep, yeah,
question.
that did answer it perfectly. And then yeah, you can go back to where you were. That's a good introduction so far.
Oh yeah, and with the Eurodollar system, so basically these private banks are creating money in the shadows. So how would it work? I don't want to really get into the nuances of that, but basically with the balance sheets, it's like, let's say I am a bank, I, Tumisho, am a bank, and you are a bank as well. So let's say you need 1 billion in derivatives, right? In FX swaps, for example. So what I will do is I will create an asset. If I am going to lend you $1 billion in FX swaps, which are derivatives, right? Because the whole system's functioning with derivatives these days. So I would basically create an asset called a loan contract. You could call it a loan contract, or you could call it a promise. It's a promissory note. So I would create a promissory note, and then you would have an account with me, and I would credit your account with $1 billion worth of FX swaps. Or if you want cash itself, or if you want the dollars itself, I would just credit you with the specific amount of dollars. Therefore, there's a euro dollar liability which has just been created in the form of a euro dollar deposit, and that expands the money supply in the shadows. Remember, we can't measure what's going on in the shadows. We can try to measure it, but unfortunately it's very hard to measure it. That's why we have certain studies from the BIS which tries to actually measure these dollars in the shadows.
Yeah, if you have
So
any links that you want to put into the Discord and have me click up into the browser tab that I have open, I'll be happy to bring resources in.
yeah. That's good. That's good. And like with regards to the Eurodollar system, it's not just the Eurodollar system itself. Also repo, because repo basically, I don't know if I should explain the repo market because it's also relevant with where I'm going with this.
Um, Go ahead. Yeah, let's see where it goes.
Okay, yeah, I'll just be brief about it. So with repo, it's the same thing as Eurodollar, except in this case with a loan, right? These loans are collateralized loans. So they are backed by collateral. So let's say I have treasuries and I need cash because I'm a corporation and I need cash to, let's say, buy supplies or to pay my employees, and I don't have cash on hand. So I have treasuries, and then I go to you and I say, hey, I need 1 million in dollars, let's say. And then you say, okay, give me 1 million in worth of treasuries. So I give you my collateral, and then you give me the cash, and I have to pay that cash back overnight or at a specific term with interest, right? Which is called a repo rate. So after I have paid you back, you have to now give me my collateral back. So I am repurchasing my collateral from you because I gave you my collateral. In exchange, you gave me money. So now when the transaction is over, I am repurchasing that collateral. So that's what the repo market is. And most of the money flowing around the repo market, it's off balance sheet. So the Fed can't measure it at all, let alone the foreign repo market. But they can't measure the domestic repo market accurately because most of the stuff is done off balance sheet. And
Since
if it's
we're
done off,
since we're in
yeah.
repo questions, did you see the articles that JP Morgan and Goldman Sachs are digitizing and creating blockchain? I don't want to call them duplicates of treasuries, but converting treasuries onto blockchains in order to, let's say, remove some of the repo from the shadows and having it be verifiable and having it be seen where it is and where it is not?
I haven't heard about that, but I think I have an opinion on that from what I've just heard from you. So if they were to do that, it still wouldn't capture it. Most of it will still be done in the shadow. So that's where JP Morgan comes in, because JP Morgan itself, they like in repo, they mostly doing tri-party repos, which means they are the clearinghouse or they are the middleman. So as I said with my previous example, if I have collateral and you have cash and you want to loan me cash, and I'm going to give you my collateral. I'm going to give you my collateral through JP Morgan. So JP Morgan is basically like a broker in this situation. So with tri-party repo, the Fed can actually accurately measure the transactions, because JP Morgan is required by law, is required to report those transactions to the Fed. What so basically with tri-party repo, yes, you can measure tri-party repo because they're obliged to report that. So it's not off balance sheet, it's on balance sheet. But most of the repo that is done is bilateral repo. It's not tri-party. So to that extent, I'm not sure. I don't have much information on that, but I don't think it'll work, because at the end of the day, the private sector is going to do what's best for the private sector. That's
Right.
the whole
Well,
reason.
and this is why I think that they're doing it,
Yeah.
because I think it was in a bilateral repo agreement between JP Morgan and Goldman. And the Bloomberg article stated that they were paying interest on repos and on reverse repos down to the minute. So for them to be able to find out that it was something around like 3.5 hours for the entire kind of like transaction to go through all of the blockchains. But they were stating that it was a better way for them to do, I believe it was a bilateral repo agreement.
Yeah, and if it is a bilateral repo, going back to your points that maybe they want the Fed to now measure what's going on with repo balances, etc. Remember, there's also an incentive for them not to report their repo balances and do whatever they're doing off balance sheet, because they are Basel. I'm aware it's Basel 3 regulations. So basically, according to Basel, I think it's Basel 3. I'm not sure, but these banks, they kind of have a constraint, so their balance sheets can't expand to a certain degree because of these
Correct.
regulations. So yes, so to a certain extent, the government or the regulators don't want banks to expand their balance sheets, which means if you can't expand your balance sheet as a bank, that means you're not going to make a lot of profit. So the best way to do it is to do it off balance sheet if you want to make a profit.
Right.
So that's one of the ways the banking system kind of gets around these regulations. So I think they still have an incentive to do that. I just don't know if this blockchain thing is actually gonna do something. Do
I
something. So
I have a feeling that the large banking system will use it for bilateral, if and only if, for the reason that if they're paying interest by the minute, they're going to want to get everything correct and down to like the big fish would be the ones that would be pushing for it. The JP Morgans, the Goldmans, anybody that would be like an absolutely massive bank, because they would want everything to be down to the penny, because I think that they could make advantages from that.
Yeah. Well, I can't argue with that. So yeah, that kind of sounds
I
plausible when you.
I've got
Yeah.
one question related to this. Sorry to interrupt you. Did you? There was a tweet recently. I have it up on the screen here, but I'll read it out to you. The tweet said, "Hands down, Cash App is revolutionizing banking with their new product update. Why have a bank branch when you can deposit cash right at a local merchant? It's arguably my favorite financial innovation since crypto." To which I responded, "Do they hold the cash in cash? Do they swap it into treasuries, commercial paper? Do they loan it overnight into repo markets? Is it FDIC insured? What happens on a bank run or a busy day? Who oversees this? This is just another centralized system pretending to help us." And I'll wrap my question up to you here soon. To the people
Uh-huh.
that might be in the macro world or in the crypto world, you may or may not have heard of Tether, USDT. There's a lot of questioning. Is Tether only holding cash? Are they holding cash and cash equivalents? Did they get into commercial paper? Maybe a precursor into what we'll be talking about later. Are they holding any Evergrande debt or so forth? So the question that I wanted to ask to you about this one was, did you hear anything about Cash App offering these services? And the follow-up question would be, do you have any thoughts or responses to me thinking that they would try to become like an overnight repo hedge fund or try to use this liquidity somehow in their own speculative markets?
Yeah, well, I'll answer both of the questions. So with Cash App, I haven't heard of it, but I suspect that it's just going to be something similar to what Tether's doing, which is basically a Ponzi scheme, if you ask me. Because if they are saying that you can
Good
basically
time to tell everybody none of this is financial advice. But yeah, go ahead.
Yeah. So I think this whole thing with with Cash App, from what I've heard from you, is I think it could be something like Tether, because Tether is a stable coin. So right, when you want to buy crypto, you have a lot of advantages for using Tether, because for one reason, it's more efficient, and you don't have to pay a lot of, because of the fees, right? Crypto has, specifically Bitcoin, has a lot of transaction fees. So if you go through Tether, it's much better like that. But what Tether does is, if people want to swap their dollars for Tether tokens with the claim that it's worth $1, right? Which we both know that's not true, because Tether has a lot of things that has nothing to do with the dollar. So what happens is, those people deposit into Tether, and then Tether gives them a Tether token. So if you deposit $1, Tether gives you one Tether token, because apparently $1 is one Tether token. So what Tether then does with your money is, they invested in the repo market, they invested in commercial paper, and you just spoke about Evergrande right now. Maybe they have Evergrande bonds. So
To jump in on you
maybe.
here, I just brought up a image on our stream, and it shows the cash and cash equivalents, other short-term deposits, commercial paper, secured loans, corporate bonds, funds, precious metals, and the breakdowns and so forth. So if you're one of the viewing audiences, there'll be a little bit of information on the screen there for you. Go ahead, back to you, Tumisho.
Yeah. So with Evergrande, I think yes, Tether does hold some Evergrande bonds, but I'm not sure, that I don't really want to get into that. But with this whole Cash App thing, I think it's going to be something similar to Tether, and I think it's just a ticking time bomb, in my opinion. I don't have much information on it, so I can't really say. So I'll only really get into something deep if I have the information about it. But it's really interesting. I think we should all pay attention to what's going on with that. So yeah, it's kind of interesting. We'll see where it goes.
Yeah. So this is then a good time to return to the tweets that we kind of like got into talking about. So we kind of like alluded to collateral markets, repo markets, EuroDollars, and just like a bunch of the big things of the banking system. And it seems to be that you and I are probably in agreement that there is a shortage of dollars. It makes sense that the dollar would go up against a basket of international currencies, and there seems to be a squeeze on the one way that I've heard the best way to find out which nations are going to be squeezed is look at the central bank forex reserves, gold reserves, and like cash and cash equivalents reserves in like T bills or some kind of thing against their amount of outstanding dollar denominated debts, in addition to whether or not their currency is kind of inflating or deflating against the dollar at the moment. And then you're going to be able to tell which ones are going to go through very, very bad monetary crises. Are
Yeah.
we're mostly in agreement on these kind of things?
Yeah. I agree. I think we're heading for a deflationary collapse in the system, because The deflationary forces cannot be ignored. Despite people like Peter Schiff saying, "Oh, inflation, inflation, inflation," I think I don't think that story is consistent with reality. So I don't see inflation at all. So personally, I don't see inflation. I think we both agree on that. I
Uh,
think we both agree on.
I do disagree a little bit. Where I am forever cautious about the amount of tools central banks, the Federal Reserve Bank of the United States, the European Central Bank, in the EU. You could even throw in the People's Bank of China. I wonder what kind of tools they're going to continue to create to prevent the deflationary bomb. I am in complete agreement with you that every indicator and or force within like the planet and or the market is leading to deflation. And what would this reason be? Is because there's more debts written than can ever be repaid. And the concern that everybody kind of has is the Evergrande crisis going to begin the contagion or begin the margin call? And I think the way that Tumisho and I might explain that part to some people that would be listening are when Evergrande goes bankrupt on their debts, and then pension funds have exposure to Evergrande bonds, and or the Chinese like real estate development markets, maybe we're being paid in commercial paper, or maybe they have commercial paper of their own. It's sent a chill from what I've seen through kind of like the Chinese real estate development sector, to the point that maybe some like retail investors aren't as interested in getting into the real estate game as they were, or maybe there is like a little bit less building development. And I don't have the data on this, but I'm pretty sure that a large part of Chinese GDP does come from real estate development and or that kind of like construction sector. And then when you begin to kind of like get into what would be a debt deflation spiral, I'll bring a video, or I'll bring an image up. Do you want to explain to people maybe what a debt deflation spiral would look like?
Yeah, and Lacey Hunt talks about this, Dr. Lacey Hunt. If you guys don't know Dr. Lacey Hunt, you should check him out. So basically, first of all, right, you mentioned, okay, before I get to the debt deflationary spiral, I think this is important because you mentioned that the central banks are going to use their tools, are going to try to use their tools to try and fight this deflation. I don't think they can, because their tools can't even do that. So think about it. Central banks have been doing, let's say, quantitative easing for what, 13 years now. I mean, everyone says that's inflationary. Everyone says that's money printing. No, it's not. It's proven to be not money printing. In fact, it's proven to add to the deflationary forces, if you ask me, because when you look at what quantitative easing does is when the Fed buys treasuries, or the ECB, or whatever central bank we're talking about, when they buy treasuries, they create bank reserves out of thin air. So this is what people think money printing is, whereas it's not, because bank reserves are trapped in the commercial banking system. So what is the goal of the Fed when they're trying to do quantitative easing? Firstly, they're trying to suppress interest rates, which they failed at doing because interest rates have been on a 40-year downward spiral. So second of all, they're trying to encourage banks to loan more because they think that bank reserves is what banks lend with, which is not true because banks create credit out of thin air. So it doesn't matter how much quantitative easing the Fed might do, even if they do 100 trillion, it doesn't matter. Banks won't lend because there's a deflationary problem in the system, which is debt. So with debt levels are at an all-time high. So if you look at government debt, I think Dr. Lysian speaks about this a lot, is that he mentions the fact that government debt weighs on economic growth. So when government gets into more debt, it weighs on economic growth. I'll pull a chart if I had, but government.
I saw your tweet, and I'm gonna be trying to push back against this one. I saw your tweet. I saw the correlation. I'm gonna bring it up on screen, and I'm
Yeah.
gonna try to, off the back of my napkin math, disprove this. It's gonna be tough, but we'll go for it.
Okay, no problem, no problem. So government debt is negatively correlated with GDP because the government has to take from the private sector in order to spend. When it gets into debt, it
Okay,
it
so
drains the.
let me put in a disagreement here.
Okay, cool.
In order for when the United States spends $1 on a bridge, we have to sell $1 of treasuries, correct?
Yeah, correct.
And we sell that $1 of treasuries to one of the 24 primary dealers, correct?
Yeah.
And then you would be saying that because that treasury has to go somewhere into the balance sheets of the private sector, you're saying that it's actually taking money either out at worst and or at best, kind of just like shifting the eggshells around or shifting the seashells around. Does that sound fair?
Yeah, when they buy those treasuries, they remove cash from the system. So cash is being drained out of the system and
Okay,
then is being
my little
yeah.
maybe counter to this would be due to the treasury markets being international, and for a very long time the international market taking up a lot of United States treasury bonds and or bills. I don't think that it was actually removing from at least the US private sector, because a lot of it was being monetized by international pension funds and or just different sovereign wealth funds. So in an
Okay.
international system, I don't exactly. I'm still trying to wrap my head around this one. I think it's more of a moving seashells around rather than creating and or destroying. Um,
Okay.
Go ahead.
I think I get your point. I get your point because what you're basically saying is, okay, I said it's removing capital away from the private sector. You are being more specific and saying it's removing capital from these international funds, these international corporations. But let me just explain how this would work. So yes, you are right that most of the people who are buying treasuries, right, are people on the international stage. So if Mitsubishi, for example, in Japan needs what let's say the US is running a trade deficit, right? It has all-time high trade deficit. So when Americans spend money on cars, let's say they spend money on Mitsubishi gets those dollars, and then what do they do with those dollars? They buy treasuries with those dollars. So when they buy treasuries with those dollars, what happens is the government then uses those dollars and spends it into the economy. So how does this drain the private sector of the capital? Because instead of buying treasuries, though Mitsubishi could buy like let's say a stock in Tesla, for example, and then Tesla could use that money to increase production, and then economic growth goes up. But if they're buying treasuries, I mean that's doing no one good because it's basically how to explain it? It's not really productive. It's not really productive when the government spends that money into existence. Whereas if they gave that
Well,
money to
hey,
Tesla,
hmm. Um,
if they gave that money to Tesla, it would be a different story.
well, okay. To counter that counter, then I hope that you don't mind this.
Yeah,
Okay, so what? Let's say that the government wants to do a huge infrastructure project, and that's what they're going to spend. We're just going to say $1 million on. That's what they are choosing to do the $1 million on. Can you guarantee me that the private sector is going to do a better job with that million than it would? Because, like you're saying, it could go into Tesla and it maybe could go for electric batteries. However, maybe it's going to go to not that. So, like, I'm not of the type that thinks all government investment is bad, because I think the government should typically do things that deal with like national logistics or like forest management or infrastructure upgrades or kind of like broadband dispersal to rural communities. So I look for government investment to go into places that I don't exactly understand how they would be profitable, if they would even be touched at all or developed by private markets.
yeah. I mean, yes. That sounds all sweet, right? I would have agreed. Yeah, I would agree with you, except that government spending, it's not really that effective. So let me just explain, right? So you are saying government should spend money more productively, right? So where does economic growth come from? I mean, that's a question we should ask ourselves first. Does it come from the government or does it come from the private sector? So if the government were to, let's say, uh, have $1 trillion and then spend that on bridges and whatever, don't you think that that is malinvestment? Because those people who would now move from their jobs and work on building those certain bridges for government, that's not what the free market wanted at that point, because the free prices are a function of what the economy needs. So in a free market economy, prices prices is basically a function of what is needed and what is not needed, because the government does not know what is needed and what is not needed because it doesn't have a profit motive, you see. So to a certain extent you could say building a bridge is good, but does the economy need a bridge at that moment? The government doesn't know that because the government is not a business. Only a business can know that, because a business has to do market research. A business has to know, is this what customers want? Is this what the economy needs? Is there demand for this? So with the
I
bridge,
don't have the data to do this the justice, but what I would say is this isn't exactly borne out because a lot of things that people say that they want don't exactly get done by the private sector. I'm gonna try to like lean on, I guess pollution would be a big one that I would talk about, or like pollution cleanup, or dealing with like microplastics in waters. I don't accept that it's impossible for a government to know what its citizenry wants, and I don't think that sometimes places might benefit from a train or like a rail system, but it wouldn't exactly be the most profitable in like a dollars and cents capacity. But it's going to improve heavily quality of life, and I guess like eventually you could look through productivity of those individuals. But I'll give it back to you here.
okay, fair point, but we can go back and forth about that, but
Yeah, this will be a good one for another time.
yeah, it should be a good one for another time, but I think it would be more important to look at the empirical evidence. So would like to maybe one day you should look at a chart and just say, okay, government spending went up. What happened to economic growth? Let's say that government actually spends one.
I do sometimes quickly dismiss historical data, sometimes potentially too quickly, due to what have been very horrid times of malinvestment and bad governance. I'm much more of a we need to reform government in order to give people the like ability to actually influence maybe where their tax dollars are going to be spent, or get into like a some form of quadratic voting or ranked choice voting or so forth. So I'm not all about just giving like current iterations and current structures of governments further carte
Yeah.
blanche checks. I think that we really need to like consider and drastically reform the way that the public can engage with monetary and fiscal policy through their governing bodies.
Yes, I mean, yes, that's what I think. I've heard this from some MMT guy that I follow. So yeah, believe it or not, I do follow people who I
Oh yeah.
disagree with.
Hmm.
So yeah, that's basically what he said to me when I was arguing with him, that okay, government needs to be reformed and government can therefore spend more productively. Well, yes, the government could be reformed and they might spend productively, but can they spend as productive as the private sector? Because it goes back to my point. When you have a profit motive, you will do anything for profit. So think about it like this. If I am selling a phone, right? And let's say I'm competing with Samsung, for example. I'm competing with Samsung, I'm selling phones, Samsung's also selling phones, right? If my phone has a problem, right? Let's say my phone has some issues, right? And Samsung's phone doesn't have issues. Samsung could easily be the reason why I go out of business. So what do I do to stay into business? I become greedy and I do anything I can for profit, which means I will satisfy customers' needs for profit. You see, so there's that profit incentive that comes with businesses. That's why everything that the government does is worse than the private sector. You look at schools. Which schools are better? Private schools or public schools? You look at, I mean, the examples are limitless, and the reason
I
why
would say
is
public roads are better than private roads, unless you have a person who is literally just dumping money onto it all the time. Like yeah, infrastructure is really going to be like the big one, and I would also go into like healthcare. I would say that public healthcare. Um, y-
really
y- well, okay, so if you're a millionaire and you're going to spend millions and millions of dollars, yes, you can get better private healthcare. But can the private
no.
healthcare system actually take care of the general populace? And in my opinion, it
Yes,
cannot.
yes, it can. Yes, it can. So let me just explain that. So I'm talking about quality, right? But if you want to go into the fact that private healthcare is so expensive, why is private healthcare so expensive? Especially in America, you have to look at regulations. Regulations are the reason. And I think this is what Bernie Sanders likes talking about. He likes talking about, oh, big pharma is gouging customers. No, that's not what's happening. If you look at the regulations, there's massive regulations with the private sector. So less regulations mean that there's less costs associated with those regulations, and therefore healthcare prices go down.
There's only one regulation that matters in that realm, and that's intellectual property. And we really need to drastically reevaluate what we allow the manipulation of IP law to do in the U.S. However, we went way down a rabbit hole. I would like to come back to something that we had been talking about of the deflation.
Yeah,
If we can come all the way back.
yeah. I mean, we got a bit distracted
Oh,
there.
I enjoy it because like it's very fascinating that you and I both have the same analysis of the monetary system, yet complete
Yeah.
different tastes for do we want the private sector to do all of it or the public sector to do all of it. But to return back to the deflation aspect, and the reason that I'm like concerned of going like full in towards deflation is I do wonder. I have some feelings that we're being conditioned to become ready for central bank digital currencies. It's become kind of like a big talk in IMF, in World Bank, in ECB circles, in Federal Reserve Bank circles of the United States, and so forth. And I think they're going to say during kind of like the next financial crisis, or I could at least hear this as a party line from a multitude of different nations. We had a difficult time getting you all payments. We were having to route it through the commercial banking system. We, didn't have everybody logged into banking. It was tough to like send checks out and so forth. It would be much better if we can just get all of you to sign up for your Fed wallet, for your ECB wallet, for your People's Bank of China like digital wallet. And kind of what I'm wondering is the next tool in the central bank's arsenal going to be a central bank digital currency that does not require the sale of treasury bills to offset the creation of the currency units, thus actually completing the move into MMT. I don't think it's actually MMT at the moment right now because you still do have to sell treasuries. And I mean, yeah, the treasuries are being monetized and bought onto central bank balance sheets. So you could talk about like, is that MMT or not? But what do you think of some of what I said there?
Yes, the short answer is yes. I think it is. I think it is the best way for MMT for us to get full blown MMT, central bank digital currency. So basically, with the central bank digital currency, I mean that is some scary stuff because first of all, I don't want to talk about the privacy parts about it, but to a certain extent, and Dr. Lacey Hunt talks about this all the time. The only way we can get inflation is if the Fed turns their bank reserves into legal tender. And what is that? Central bank digital currency. Because their balance sheet is, we are going to have, we're basically going to bank with the Fed. Therefore, our deposits with the Fed is basically bank reserves being turned into legal tender in the form of central bank digital currency. And if we get that, that's hyperinflation. So, I mean, that would be MMT's dream. I mean, maybe the MMT proponents would dream about it all the time. But I think with that, with MMT, I don't think it's gonna end well because you won't be able to control the inflation, and I think they'll get velocity up because apparently with this whole central bank digital currency, the central bank, right, like the Fed, could basically give you money, and then there's a timer on how long you could actually spend that money. So let's say they give
Programmable currencies actually already exist in the United States. The way that our food stamp programs work here, they're only allowed to be, or they only work on certain goods. Like they won't work on prepared food, and they won't work on a shirt. It only will like register through the system on like food products. So to build onto your point, it's not difficult to create and or develop programmable currency, even to the point of time duration programmable currency. To your point,
Yeah, hence I say the probabilities are high for that to happen. So if we get something like that where there's a timer on how what on how you can spend your money. So I think if we get to that point with the CBDC, central bank digital currency, that's going to push velocity way up, and people are going to spend their money quick, 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 and then you get hyperinflation. That'll just reinforce the hyperinflationary narrative. So the only way I can be on the inflation side is if, and by the way, I have been on the inflation side like for I think I switched into the deflation disinflation side a few months ago. But before then, I was drunk on the whole inflation story. Like Peter Schiff, I listened to his podcast. Till this day, I still listen to his podcast every day. Every single episode that he releases, I'm there. But
You don't say. I didn't hear any of him in you throughout our conversation.
exactly, but yeah, I mean, yes, he talks about inflation all the time. So, I mean, I kind of get pissed when he talks about that. But at the same time, I love his podcast because he kind of he stands firm in what he really believes in, because he believes in small government. So that's something that I subscribe to. So yeah, that's one of the reasons why I listen to him. But going back to my point with inflation, the only way I can be on the inflation story is if we get a CBDC or something like that, where bank reserves turn into legal tender. And I mean, Jeff Snyder would argue that MMT is actually deflationary. Would you believe that?
He said, well, it defines how it determines on how you define MMT. And like,
Yeah,
yeah, like, because to me, we have like a fiat. I kind of term fiat currencies that are, quote, backed by treasuries, quote, as fiat 1.0 currencies. And I say a fiat 2.0 currency is one that is no longer backed by gold and or treasuries. So I think that there's like a descent from, like, you have like type system 1 money, which is the like physical specie that you trade. So that's like gold and silver. There's type 2, which is like paper backed by gold and silver. Then there would be type 3, paper backed by paper, the treasuries and so forth. And then I think type 4 would be an actual non-backed. You could almost call, I guess you could almost call Bitcoin a type 4. It's technically not backed by anything in some kind of sense, if you want to
yeah.
look at it that way. But under my definition, a currency
So
that has no tether to any precious metals or any treasuries would be a complete fiat 2.0 and or type 4 currency.
yeah, 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 yeah. I think yeah. I think how do I say this? How do I say this? So with that with MMT, yeah, it really depends how you define MMT. I mean, some people might say what Japan is doing right now is MMT, because I mean Japan is suffering through a deflationary spiral. I mean, till this day, I mean, what is the inflation rate in Japan? 2 basis points. I think that's the inflation rate in Japan. And despite massive fiscal spending by Japan, I mean, they've been in a deflationary spiral for like 30 years now, since the 1990s. So, I mean, to point out to Jeff's point, I mean, yes, MMT could be deflationary if it plays out like that. But, I mean, with the central bank digital currency, it has to be inflationary. I don't see how that could be deflationary at all. I don't see how that could be deflationary, because that money came out of nowhere. So to an extent, the Fed can basically um, create money into existence, and the government just spends it, just as the MMT guys say, they just spend it into existence. And then somehow when they fight inflation, they have to increase tax rates or something stupid like that, which I won't get into the nuances of that. But yeah, I think that's what I have to say about MMT.
Cool,
I
cool.
don't think I have
I think
else to say.
to give my, like, I guess, full thinking on like deflation or Evergrande or how this might all happen. I do have big concerns that once kind of the Evergrande contagion would go around, if there's going to be downgrades on commercial debt, if the U.S. 30-year continues to get close to junk bond rates, there could eventually be like a sale on junk bonds, and then this is kind of what could be, the '08 moment that could begin what I would consider to be like the currency crisis, which is, to me, how I'm going to call the next like financial crisis that we go through. But one thing that I kind of learned from Raoul Paul and a couple of people is, and something I kind of want to say about like why a deflation spiral stays a spiral is, let's assume that I am a 50 or a 55-year-old person, and all of a sudden, over like a 9-month period, my 401k portfolio is maybe worth like 12% less or 13% less. That begins
Yeah.
to have an impact on my day to day spending and on my consumption habits. And maybe I begin to then save a little bit more money. So the thing that I kind of have up on the screen is you have falling demand, which leads to business losses, to falling prices, to layoffs and wage reductions, to debt defaults, to bankruptcies, to falling tax revenue, to increased real debt burden, to falling demand. So the reason that central banks planetary try to fight these deflation spirals is the way that our monetary systems have been designed. We need perpetuitous and forever growth.
Yeah, well, with the whole thing, I don't think a deflationary spiral like that would play out where your 401k is gone down and then you start spending less. I mean, yes, you could spend less on some things, not everything. I mean, you can't spend less on food.
Oh,
I mean, you
no,
have to.
we're only talking like small points here. Like if each person just buys one less T-shirt, like that has a big impact.
Yeah, well, like consumer prices are broad, right? So it depends what consumer prices are you talking about. I don't think you'll get deflation in food and necessities like that, but yeah, what other stuff you might get that kind of deflation. But
I am on the inflation train for commodities, for food, for yeah, like real items like that. I am on the inflation train still for a while. The more that climate events affect supply chains, the longer that supply chain issues kind of like take place. I'm a Nouriel Rubini person. Do you know Nouriel Rubini?
no, unfortunately.
He's like they call him Doctor Doom. He's a bear, doomsday sayer or whatever. But he kind of has like a theory about the decade of depression, and like 10 kind of like deflationary or depression forces, being deglobalization, like reshoring of manufacturing would lead to increase in cost of goods. He thinks that climate change is going to continue to wreak havoc. He thinks that the problems between the United States and China, the bifurcation of their 5G systems with Huawei's being just cheaper and faster objectively than the EU or the US variant, that's going to be leading to differences. So I think the things that we want to get cheaper are not going to. But I think that markets could eventually begin their margin call or their deflation spiral.
Yeah. But then again, it also depends how do you define inflation? Because yes, consumer prices can go up, but that's not inflation. Because inflation is a rise in consumer prices over a prolonged period of time caused by an expansion of money or credit. So without the money, you can't get inflation. Yes, you could get consumer price increases, but that's not inflation if it doesn't last for long. You
Oh,
see,
I think
so
it's
if
here
it
to I
goes
think it's here to
on,
last. I think it's here to last from what I've
what I
seen.
basically what I basically mean is like a very substantial rise in consumer price. I'm not talking about like 2%, 3% CPI. No, I'm talking about like 10% CPI, 15%, 20% CPI. If that goes on for like 10 years or 5 years, 5 years or more, I mean, yes, that is inflation. But the only way you know whether we'll get inflation or not, and I'm talking about the inflation according to how I defined inflation. I mean, it's Webster's dictionary, 1918, Webster's dictionary. That's how they define inflation. If you get inflation, the real inflation, not just the small rise in consumer prices, if you get real inflation, the only way you can get that is if there's an expansion of the money supply. And the majority of the money supply comes from the shadows, the Eurodollar system. So if you do not get an expansion in Eurodollars, you're not going to get inflation. And the bond market is telling us that with 10-year yields going down. So yields are still low on the 10-year, on the 30-year, on the 20-year. And that's basically telling you that no, we do not have inflation. I'll give you an example. 1947, 19 and the 1950s, we had consumer prices spiking up, but that was supply side. And I hear you talking about supply side inflation, where climate change and these kind of things are going to put a bottleneck on goods and prices are going to go up. Yes, that is a rise in consumer prices, but that is not inflation. You see, because the privates at the end of the day, the private sector or the private system, the free market, has a way of solving these problems. So these things do not last. The only way it can last is with monetary inflation. And when we do get monetary inflation, the bond market reacts accordingly. So the bond market is a very good predictor because it's always been correct about inflation, real inflation. You can look at times when inflation has skyrocketed. I mean, in 2008, just before the financial crisis, the CPI was at like 5%, if I'm not mistaken. It went up, and everyone's like, "Oh, inflation!" But the bond market, the 10-year, went down in 2007, way before CPI went up, because the bond market was pricing in a financial crisis, was pricing in a deflationary collapse. So, and what happened in 2008? Deflation. What happened in 2011 when we got consumer prices going up? Everyone was saying quantitative easing is inflationary. Yes, we are definitely seeing this inflation now. The quantitative easing chickens are coming home to roost. And then what happened? Did the bond market go up? Did the yields on 10-year treasuries go up? No, they went down. And what happened to the CPI? The CPI came down as well. And despite all these things, like climate change and whatever supply side issues might result in short-term spikes in consumer prices in the CPI, those things will not last without the monetary aspect of it, because that's how it's been consistently throughout history.
Yeah, I do agree with you. You did teach me a little bit better way to say that I think there are going to be supply side pressures that are going to lead to, I call them over this decade, price rises. Dan, you've read a lot of stuff. Good for you for being like 19 super informed.
Yeah, I mean, we all have to learn. I mean, yeah, and basically, I heard this from Jeff Snyder this morning. The whole thing, he was just comparing the 1950s, 1947. Yeah, it was kind of interesting. I think it was in one of his episodes. Yeah, one of his recent episodes.
Jeff is definitely a smart person.
And, yeah, smartest person I know.
Yeah, is there anything else that you really kind of like wanted to dive into as we were here chatting and hanging out?
Yeah, I think yes, just something regarding inflation and quantitative easing, because I was just talking to someone on Instagram about it, because I mean everyone, especially everyone in the, I mean I'm a free market guy, right? I believe in freedom and liberty and free markets, right? So, and most people in this free market camp, to say, I think camp is the right word. Most of these people are, oh, the Fed is printing money. Everyone is saying that. I mean, that's why I disagree with most of the free market guys, because the Fed is not printing anything. I mean, yes, inflation, we saw the CPI numbers, was it yesterday? 6.2% CPI year over year, 0.9% month over month. Big gains in the CPI. And everyone is saying, aha, we told you, inflation is here to stay. But then again, they don't understand how the monetary system works. They said the same thing in 2011. They said the same stuff in 2008. They said the same stuff in 2014. They said the same stuff in 2019, when bond yields were doing the opposite of what the CPI was doing. So, I mean, guys, quantitative easing is not inflationary, because quantitative easing is just an asset swap. That's all. Those bank reserves never leave the system, because some people think, okay, after the banks get these bank reserves, when the government then spends money, they're spending bank reserves, right? Because the TGA, they're spending out of the Treasury General account, and that's a liability of the Fed, right? So those are they see that as bank reserves, and they say, okay, because all liabilities of the Fed are bank reserves. Well, that's not true. The TGA isn't bank reserves. It's okay, yes, it is bank reserves, but were those bank reserves newly created bank reserves from quantitative easing, or was it just money that existed already? So you have to ask yourself this question, because I was talking to Ryan Miller about this, and you guys could listen to his interview. I interviewed Ryan Miller recently on my podcast, The Well Show with Equity Kings, so you guys could check it out. But he basically explained how a treasury auction works, because I think people are saying inflation, deflation, because the government auctioned out a lot of treasuries, and they did stimulus spending. We could argue why that is good or bad, but I don't want to argue about it now. But whether it's good or bad, the government did spend money. So people are saying that money that the government spent is inflation because that money came from bank reserves, which were newly created by the Federal Reserve, which is not true because when a primary dealer buys treasuries, they do not buy treasuries with bank reserves. They do not because bank reserves aren't legal tender. What banks usually do is they can use bank reserves in the process of buying treasuries, but they don't necessarily buy it with bank reserves. So what happens is on auction, right, when let's say the treasury wants to auction out 100 billion in T-bills, right? So if they want to auction 100 billion in T-bills, what happens is the primary dealer goes to the treasury and say, hey, okay, just give me the treasury. I will give you my bank reserves as collateral. You see? So I'll give you my bank reserves as collateral, and then come settlement date, when we have to settle this transaction, I will get the cash that you need. So what does the bank do, or what does the primary dealer do? Because the primary dealer is in the business of dealing. It's a dealer, so it's dealing with treasuries. So what the primary dealer does is it takes those treasuries, those new treasuries that it got from Janet Yellen, and it takes those treasuries into the repo market. It pledges it into repo, it gets the cash, and then gives Janet Yellen that cash. And then after it gives Janet Yellen that cash, what happens is they basically give the primary dealer the bank reserves back, and then the primary dealer is made whole. How the primary dealer pays that loan back, I don't know how it works because I haven't researched it that far. But they do not use bank reserves to buy treasuries. They only use it as collateral. They do not at all. So understanding that will help you understand whether inflation is transitory or not. Because if quantitative easing was truly inflationary, it would correlate with the money supply. I mean, people can point out that, 2020, March, money supply went up and the Fed's balance sheet went up as well. I mean, yes, the Fed's balance sheet went up at the same time the money supply went up, but that doesn't mean correlation does not mean causation. I mean, for those who understand statistics, because if that was the case, it would always correlate with so basically, if the Fed's balance sheet continues to go up, which it's done that because the Fed has continued its quantitative easing purchases, but the money supply flatlined. The money supply flatlined, and now it's actually contracting. So what does that tell you? How is the money supply contracting when the Fed's balance sheet is still going up? You see? So how can you possibly make the connection between the Fed's balance sheet and the money supply if they don't even correlate at all? If it only correlated once in one event, that doesn't make sense to me. And that's assuming that the money supply accurately measures the entire money supply. Because as I mentioned in the beginning of this talk, there's repo balances which are used in the real economy, which are not captured in the M's or M1, M2, M3 money supply metrics. And we haven't even mentioned EuroDollars. So you see, if we had to assume that the M's and the M2s and the M1s and the M3s accurately captured money supply, even if that was true, it has no correlation to the Fed's balance sheet, which means that QE is not money printing. Because if those bank reserves were actually going into the real economy, it would have an impact on the money supply, which it doesn't. Because the only reason the money supply went up in 2020 was because of government PPP loans, which goes back to my point: is the government has no that money, that credit came from the banking sector. I mean, yes, the government forced the banks to give out PPP loans, but where did the money come from? It came from the banks. You see, and that's what expanded the money supply, credit creation. And that's why the money supply is contracting, because credit creation is going down. It is contracting. Banks are not lending. They were only lending for that short period of time because of COVID relief. That's what expanded the money supply.
Wasn't
Yeah.
wasn't there one round of the QE that shifted from kind of just being QE to actual debt monetization?
Could you please?
There was, because originally it used to just be reserves out and then treasuries in. But when the Fed bought their $1 trillion worth of treasuries in 2020 and then going through the PPP loans, didn't the Fed actually monetize the PPP loans and purchase actually purchase assets in cash, or was it always just in reserves?
It was always in reserves. it was always in this useless form of money, which is bank reserves, which
Okay.
never leaves the banking system again. Which means that there's no way you could actually have you could actually point out to a relationship between bank reserves or the Fed's balance sheets and the money supply, because that's not how the
Well,
system
I
works.
guess
I
I
mean,
get. Well, in let me see if I can. I'm gonna have to do some more research and go back to listen through this because I can't exactly remember our part. But that's fine. This will be like a good beginning of an end of our first chat. I imagine that we're gonna have one again at some point in the future. My
yeah,
question here is gonna be technically now that they're paying interest on excess reserves, the IOER rate. Technically, isn't that now slowly, gently monetizing reserves?
yeah, with interest on excess reserves, I mean, yes, but the question you'd have to ask yourself is, what is the Fed using to pay that interest? Are they using cash or are they using bank reserves?
Right. Yeah. No,
Yeah.
what I'm gonna do for our next time is I've read a lot of Lynn Alden's work on QE. I read a lot of Jeff's work on QE as well, but I need to brush up again. Because there's a point that I want to make, and I just can't remember it. So for round two of the conversation, if you're okay to do like a gentle wrap up here, it would be going back into that if you wanted to chat sometime.
Yeah. That would be lovely. I would appreciate that.
Yeah, do you want to start to do like a shout out for yourself and kind of like a wrap up or like a closing topic if you wanted to hit on one or so? We've been going for exactly 1 hour now.
I don't have anything in the tank anymore. So I don't think there's anything I want to talk about. But yeah, if you want to find me, you can find me on Twitter at NXTURE boy. So Nature Boy on Twitter. You could listen to my podcast with that I do with my good friend Sia on it's called The Wild Show with Equity Kings. It's on every single platform basically. And we talk about these things macro, we talk about politics, we talk about the economy, we talk about business, finance, basically those stuff. So we talk about a whole bunch of those things. So yeah, you could listen to my podcast. Yeah, and yeah, that's all for me. That's all from me.
Yeah, I'm looking at your Anchor FM right now. Tether unstable coin. So it looks like you went through. Yeah, that was in August too. I remember when that data came out. And I
Yeah.
remember when the reverse repo skyrocketed. It was a wild year. It was definitely a wild year.
Yeah. That's basically the podcast. So yeah, we talk of different things in the news. If there's something in the news, and we'll just talk about it. But before, in the past, we weren't very consistent with the podcast because we'd release like one episode in like 2 weeks. But now, like we're releasing more consistently. We're gonna start maybe 3 episodes a week and just like that. But three short episodes, and then like once a month we'll do like an interview with someone. Because recently I did an interview with Ryan Miller, so I think that's a very very insightful interview. He's a smart guy, extremely smart. Very smart. So I think he's way smarter than me. I've learned so much from him, and I think your listeners would learn a lot from him as well.
Yeah, I'll be checking out. I saw a part of that in your tweet thread. And then for me, I'm Brad or Touring News. If anybody wanted to find me, it's Touring News One on Twitter. I started some kind of my idea was I wanted to have an open source newsroom where I live broadcast news analysis and research, and utilized the fact of having a live chat being able to kind of correct me in real time and give sources in real time to try to get like a decent news team or research team or journalistic project going. So I've been doing that for about like 2.5 years. Kind of taken like a path down the agricultural route. So I just finished up a 4.5 month road trip, going to a bunch of different farms across the United States and learning about that. And now it's back to the streaming aspect. So Tumisho and I met yesterday, just happenstance through Peter Schiff thread, and put this chat together this morning.
Yeah. I think it's very good that we network, and yeah, I mean, you could network and find a lot of interesting things on Twitter.
Yeah, I Twitter is my favorite of the social media platforms. It can
Or
be
some people
it,
insult you.
what's that?
Or some people insult you on Twitter. So
Oh, for sure, for
depends.
sure. I mean, there's a negative side to it. However, a lot of academics kind of hang out around Twitter. So That's
Yeah.
a decent thing for it. So yeah, I am going to hit end on our recording, and then I'll still be in the voice chat to like say hello to you real quick. But thank you everybody for tuning in. You can either find this on Tumisho's Anchor FM somewhere. I'll have it up on my YouTube on Touring News, and I'll be getting the video to him to put out somewhere. So give us a comment, find us in our DMs or so forth, and I hope you all have a great day.